Well, it may take nerves of steel to start buying stocks during a market tailspin, but believe it or not, this could be a perfect time to go shopping in our ongoing effort to tell you how to stay up in a down market. Let's dig into what you can do today, from staying in the market to moving your money around a little while this time passes. All times pass. The Money Guy portfolio manager Brian Preston of Preston Cleveland Wealth Management joins us. He's in Atlanta. And Mr. Money, Mark Rothstein, who's in L.A. Both talk about this on the radio. So, Brian, first to you. Now, you got some specifics. First of all, do you think it's time to go in and get some bargains?
Well, I definitely think there's some opportunities out there. It's not all bad news that's come out, but we've definitely had enough news that we've had the pullback come back where people are starting to recognize there's enough scared money out there that has come out that there might truly be some opportunities. I mean, we're off 15% in a lot of these stocks that are out there. So if you go out there and buy some good index funds, you might have some opportunities. Mark,
now I know you guys both have some tips, but I want to quickly ask you the same question. Mark, are there any buying opportunities at this level in the market?
Not right now. There is so much economic worries out there, having to drop those interest rates 3/4 of a point overnight while I'm sleeping, the economic stimulus package they want to bring in, the U.S. dollar going down, the subprime housing. I can go on and on.
Yeah.
There's too much going on. Do not go in right now. It's not the time.
Well, Brian is not quite that pessimistic because, Brian, you have a longer time frame, I think. And let's put up your 5 tips as we get them. First of all, I believe the first one is create a plan, and this involves focusing on your goals and how much risk you can handle, right?
Yeah, I think most people, if you look at your portfolio, a lot of people come in without actually having a plan, and that's why they kind of have a hodgepodge of all kind of different things, and it's never working for them because they're not putting a progressive plan together that's actually going to reach their goals, and they're not taking into account their risk. Let's face it, we have different risk levels when we're all making money, but then when the market comes down, all of a sudden we all get scared, so that's not having a good plan, so you kind of freak out.
Number 2 is consolidate and simplify. How do you simplify your plans, Brian?
Well, you've got to have all your accounts consolidated where they're all working together. I can't tell you how many times I get portfolios where people come in, they have a 401k and IRA, they're doing completely different things. You've got to make sure you're looking at everything as one big pizza pie that's working together, so you have asset classes represented all the way across the board.
All right, and number 3, as we can see there, think long term. If you're thinking, what, 6 months or so, you're going to be in bad shape with this market, right?
I get emails from people that listen to the radio show and say, hey, I've got a wedding coming up in 6 months. What, do you think I ought to pull my money out of the market? Of course you should be out of the market. There's no reason you should be in the financial markets if you can't let that money go for 3 to 5 years.
And then you say something that kind of mystifies me. Modernize your portfolio. What does that mean?
Well, if you think about it, I think most investors are investing like it's 1987. There's a reason that we don't have TVs as furniture anymore. We're walking around with tape decks, we have iPods, and we have plasmas and LCDs. You've got to diversify. The endowments and the big institutional investors went beyond just stocks, bonds, and cash in 1987. It's time for us to do the same thing. Start bringing in some long-short funds, some absolute return strategies, some market-neutral funds that will make money.
What is a market-neutral fund?
It's a fund that tries to make money no matter whether the market's down or up.
But that's impossible. Everything is a gamble.
Well, not necessarily. If you go look at some of the strategies, just like you have bear funds in the Morningstar categories, you also can have long-short funds that flip a switch when they think things are overpriced. They will make money.
It's essentially covering all bets. And then number 5, buy holdings at reduced prices. Well, that makes sense. And the question is, when are prices reduced enough?
Well, that's one of those things that nobody's going to know until we actually come out of it. But I will tell you this. If you're not in the market when the recovery comes, it's too late because, if you look at what happened in 2002 to 2003, you had in the first month, you had from October to November, you had a 15% rate of return. If you look at the first 12 months of the recovery in 2002 to 2003, you had a 33% rate of return. So the only way you're going to get that outsized return is if you're in the market.
All right, we got one more question for you, Brian, when we finish. But Mark, we haven't forgotten about you. What are your tips? Very quickly, 10 seconds. When is the market going to turn around? Mark, what do you say?
I would say it's going to be much later this year.
Much later, which means like third or fourth quarter. Brian?
That's exactly
I think after all of the scared money gets out is when we're going to find the foundation, just like what Cody talked about in the first segment.
All right, and you don't want to give a date?
No, no dates here.
All right. Well, at least Mark gave third and fourth quarter. Thanks, guys. Appreciate it. Coming up on deck, the show did go on today for the Oscar nominee announcements. Film Power Rankings when we return.